But focus in then on some individual earnings as well. And Raymond is in focus. The consolidated loss was very disappointing at 16.6 crores. The top line growth was just about flat, while the margins came in at 3.36% versus 3.39%. In fact, the stock is clearly feeling the heat and reacting to those numbers as we speak. It's deep in the red. Sanjay Bahl, Group CFO Raymond, joins in on the show. Mr. Bahl, could you walk us through the key highlights of your Q1 results? What were the factors at play this time?
Percent in growth in the gross margins, 5.1% growth in EBITDA, and at a PBT level, there's a 17% increase. At a PAT level, you see a negative of around 15%. So if you look at these underlying results, we must also factor into account the 12 crore one-time benefit that was accounted for in Q1 of last year. That was on account of a 8 crore one-time power subsidy and a 4 crore gain on account of a sale of a immovable asset in our apparel business. So after we adjust for a 12 crore benefit accounted for last year, which was one time, the underlying EBITDA for the current quarter registered a 32% increase. So that's the underlying result, a 4% growth in turnover, which on an underlying basis is around 5.5%, and the EBITDA increase, which is showing a growth of 5%, is actually a 32% increase. So that's the underlying result for the quarter. Also, I would like to also mention that Q1 traditionally is a weak quarter for the suitings business. And that has always been the case because of a seasonality factor which gets in, which is there in the business. And this year was especially a tough year as far as consumer demand is concerned, with a very sluggish footfall into the stores and malls, and also a demand which was impacted because there was a complete absence of festival dates and marriage dates in the quarter as compared to last year.
All right. Mr. Bahl, do you have plans of strengthening your brand presence in the Middle East?
See, the Middle East, we have recently set up a management team headed by a senior manager. So the team has just been put in place. We are looking at the opportunities in expanding our presence in the Middle East region into leveraging the brand potential that is there in a branded apparel as well as in the suitings fabric business as well. So that is an attempt which is there to both on the retail side as well as on the institutional side to expand the business and the portfolio.
Let's talk about the margin contributions for each segment of the business and what kind of growth are you penciling in for FY17?
If I look at the segmental results now, while I've spoken about the difficult conditions for the suiting business, however, the other business segments have clearly outperformed, which has resulted in the turnover growth and the profit growth that we see coming in the quarter. So our shirting business has carried on in the momentum of growth and has grown by 26% with a margin growth of around 33%. Our branded apparel business has grown 17%. Margins have been flat, primarily on account of the early onset of the end of season sale, which has been preponed to June by all retailers, which normally comes in July. Our garmenting business has grown significantly at around 19% in the quarter, with a EBITDA growth of 60%. And if you come to the other businesses, the auto business has seen a turnaround in this quarter, with which is facilitated by the increase and surge in sales in the commercial vehicle segment. So our turnover growth has been 14%, and margins have increased in this business, and the EBITDA has doubled from 3 crores to 6 crores. So overall, the other sectors have performed very well, and that's a positive sign as we look into the rest of the year.
All right. What's the update on the international operations and expansion plans in new areas?
See, the expansion plan, we will continue to invest in growing our branded apparel business. So the expansion on that will continue. As we have stated in the past, a plan for renovating our stores and expanding our branded apparel business, our Park Avenue or Raymond apparel stores. So that emphasis is going to continue for the current year as well.
Mr. Bahl, leave us with some sort of a guidance. What can we expect from Raymond by way of your top line, your EBITDA, as well as your margin performance, and what's the general business outlook for FY17?
While we do about 1,100 crores of business in the first quarter, traditionally, if you see the remaining quarters have seen around 1,500 crores of business for each quarter. So that's how the seasonality comes into our business and has an impact on the business. Now, we have been able to see momentum and growth coming in this quarter in all our business segments. Suitings, we clearly see growth coming in the remaining quarters. Our trade bookings that we have witnessed for the next season is very encouraging. Our TechnoSmart product that we launched in the last quarter has received a very good response from trade and consumers, and that has received a very encouraging booking even ahead of season. So, and that results in an increase in our ASP as well. So we are quite positive about the flagship suiting business growth coming in. And the other businesses, the momentum is likely to continue. Growth momentum, as I explained, the first quarter has been good for all the businesses, whether shirting, garmenting, or auto business, or branded apparel business. And this growth momentum is going to continue.
Bahl, we leave it at that. Thank you so much for joining in on ET Now with your perspective on the Q1 results and your outlook going ahead. But moving on, addressing his last AGM as ITC chairman, YC Deveshwar said the company aspires to be the #1 player in the new FMCG business and has a revenue target of 1 lakh crore rupees by 2030. Listen in.